Well, thank you to David for hosting us here at Brunel Business School today, and to Jill for inviting me to speak today. And good morning, everyone, and thank you for this opportunity to contribute to your symposium. And I'm delighted that integrated reporting will play such a prominent role and feature of this symposium today. And what I wanted to do really was introduce integrated reporting through the prism of some of the trends that are happening in the world today, and then hopefully land on where we are with the evolution in corporate reporting globally and also here in the UK. And really, from our perspective, there's a reorientation taking place in corporate reporting globally. And this reorientation is being brought about by a quickening pace in the evolution of the relationship between business and society, particularly over the last half century. And there's been a radical transformation in the expectations of business by society, and increasingly of regulators as well, driven by recognition that large corporations have a significant impact on society and the environment. And we're all aware of the facts that of the 100 largest economic entities in the world today, over 40 of them these days are businesses rather than economies. And the fact that was from the 2014 research showing that the company Apple had a greater market valuation than the combined value of the Russian stock market. So the power of individual companies and the responsibility of individual companies within society and within economies has substantially changed, radically changed, and that has put pressure on those companies, particularly from societal forces and from regulators as well. And in much of the public discourse surrounding this new environment of radical transparency and increasingly broad stakeholder expectations, business has soaked up quite a lot of the blame for all manner of social, economic and environmental ills. And we've seen social movements, as we're all aware, from Hong Kong to London to New York, that have mobilized support for a different economic model, even replacing capitalism, challenging capitalism. And it's true that in most cases, businesses and our capital markets have failed to respond quickly enough to these changing circumstances. And that has resulted in a number of gaps in corporate reporting, corporate governance, and the capital markets. And those gaps are in governance in respect of accountability of business to their principal stakeholders, including investors, but also wider stakeholders. Valuations, where the market cap of companies no longer reflect the true value of those companies, and critically trust. And that is absolutely vital as you see global corporations trading on the basis of brands that demand the trust of their stakeholders in order to support their valuations. And the impact of this is that capital markets are no longer able efficiently to raise risk capital, because the price mechanism within those capital markets is failing, because the information flow from the business to the market is being clogged up by misinformation, and that is causing the potential for market failure. And corporate reporting, which in many ways has been seen as the boiler room of corporate governance, has got caught up in this debate in a number of unexpected and suboptimal ways. And new layers of disclosure have been added with the associated burden of cost and complexity. And what we find in integrated reporting, when you speak to the corporate reporting teams, is just how burdened they feel within the business and how unloved, frankly, they feel within the business. And when you speak to the CFO or the CEO of companies, they see corporate reporting as a cost on the business or a compliance burden to be absorbed, rather than as an opportunity to communicate with their investors and to tell the story of their business. And philosophically, corporate reporting is still largely based on the principle that financial reporting has primacy over other forms of reporting. And every new layer of reporting has amplified the current system's limitations as a largely backward-looking and transactions-based reporting model. So much so, as I said, that the price mechanism, the share price, no longer represents the value of the business, whereas broadly it did a generation or so ago, and I'll show some research in a moment which highlights this. And these new layers of reporting have often introduced new definitions and complexity, because those definitions are of familiar and established concepts such as materiality, and they've blurred the lines between information that is presented to investors and information that is presented to other stakeholders. And that has created now a new category of information, non-financial reporting, which was born and which encompasses sustainability reporting and corporate social responsibility reporting. But while this new form of reporting may have connected business to other stakeholders, at the same time it has disconnected the business from what the law considers to be the primary audience, the investor. So when you speak to investors, particularly mainstream investors, about non-financial information, and the discourse is changing, but traditionally they have seen that information as separate from the strategic information that drives the information of the business, which is seen through the prism of financial reporting. And while there have been efforts to account for value creation in the modern world through the development of sustainability reporting and CSR reporting, this has been done in silos, which has often separated that information from the main strategic information that is presented to the market. Now, I must just say before going on that I'm presenting an international story. In a few moments, you're going to hear from Deepa. And what I do want to say is that we find this wherever we go in the world, that the Financial Reporting Council here in the UK and basically the people driving corporate reporting reform here through the strategic report and through things like changes to the corporate governance code, which talk about long-term value creation, and developments in the UK such as the stewardship code, which have really caught hold around the world. I do want to say that the UK is in many ways leading innovation in reporting, and that is really taking hold globally. So many of my reflections, although they're true in part here in the UK, they're more reflective of the kind of global picture, because we are seeing a lot of innovation that is coming from the Financial Reporting Council, which Deepa will talk about later on. So that analysis brings us to integrated reporting and why the IRC was established about 4 or 5 years ago. And what we're seeking to do, and what our vision seeks to do, is connect corporate reporting to the macro goals of financial stability and sustainable development. And in doing so, I just want to borrow some of the thinking of Tomorrow's Company, the think tank Tomorrow's Company, and its chairman, Mark Goyder, who says that a company is more than a set of numbers and a legal structure. It is actually a living system and can be seen as a living system where the employees of the company are its lifeblood, the strategy of the company is its brain, the measurement and communications are the central nervous system, the culture of the company is its DNA, the leadership and continued entrepreneurial energy are its soul and spirit, and the governance and accountability, which I want to talk about, are the rhythms and disciplines that keep the organisation lean and fit. And I would argue, too, keep the organisation honest, that accountability, that link between what the company is, what it is doing, and what it is saying to the outside world. That is what keeps the company honest. And what the focus today is about is accountability through corporate reporting and governance over the living system that keeps the company honest. So I come to the point here about why integrated reporting. And if reporting is only going to be concerned with tangibles, with the financial reports of the company, then it is moving out of step with how the business is actually being run and how it is actually creating value. 40 years ago, the financial reports of a company were a fair reflection of the market valuation of that company. You could trace the market capitalization through when you look at the balance sheet and the financial reports. Today, only about 20% of the value of a company can be accounted for by the financial reports. So much of the value of a company today can be found in the intangibles, the brand, the copyrights, the patents, the trademarks, its reputation, those intangible factors that cannot be captured or aren't captured sufficiently by traditional financial reporting. And so what we're seeing is that if this is the case, then there is an accountability gap within the business. The investors won't be asking the right questions of the management to determine their investment decisions. And this feeds a cycle of short-termism within capital markets. And so this analysis really creates the need and the space for something that isn't completely new. The last thing integrated reporting wants to be is an additional reporting burden on business. But it is something that, a set of principles that helps to reorientate the corporate reporting system towards the needs of the 21st century. And what integrated reporting seeks to do, as this diagram shows, is amplify those issues that investors and other stakeholders want to see from the company. So more focus on strategy and governance, more focus on implementation plans, and more focus on business as usual, rather than limited strategic focus and a large chunk of the information being presented as past performance. It's like we've been driving a car, but only with our eyes on the rear view mirror looking backwards. And what we need to do is look forward through the windscreen, as well as looking left and right to give context to where we're going on the journey. And the rear view mirror is an essential element, but it should not be the only way that we look at where we're heading as an organisation. And another way of thinking about that is through the idea of lines of sight. And in many ways in corporate reporting, in financial reporting, we've mastered the issue of oversight, the regulation and the strong systems of law and regulation that we have overseeing corporate reporting. And we've also mastered hindsight, past performance of the organisation. But have we really mastered the issue of insight? Do we really get in our financial and corporate reporting an insight into management decision making, how they're using all the resources available to them to create value over time? And is that driving the discussion between management and investors and other stakeholders? And also the issue of foresight. Does corporate reporting give the reader enough information about the issues that are actually facing the company going forward, the trends facing the industry, the trends facing the company, how the company is responding to those trends in terms of accessing resources and deploying those resources to create value over time? And this is an issue that Mark Carney, the Governor of the Bank of England, has referred to in his analysis, which he calls the tragedy of the horizon, where there are risks that we all know about in our business lives that are coming 10 or 15 or 20 years down the line. And in the case in the speech that he was talking about, he was speaking of climate change, where we know that there are climate risks 10 or 15 or 20 years ahead, but we're trapped in a disclosure horizon within corporate reporting of at the most a year into the future. And we need to get rid of that trap, of that disclosure trap, and start speaking about the real risks that are confronting business and our economy, so that we can take into account today and manage resources today to take into account those future risks and address that tragedy of the horizon. So, I've already set out some of the challenges to the status quo, that we want communication, not compliance and box ticking, that we want to see strategic information across the range of resources that are managed by a company, and not just financial information. And we want forward-looking information, not just historic information. And we believe that by bringing together and giving parity to resources other than financial resources, and presenting that in a way that is strategic to the business and to its stakeholders, you will actually create a communication that is both concise and more meaningful to those who are reading those reports and allocating capital both within the business and within the capital market. But of course there are other demands from stakeholders, and the big question and it's an academic question, but it's also a practical question as well, is how does this square, this demand for kind of unique information, a unique story of value creation across different capitals, some of which may be easy to measure and others that may not be, how does that square with demands of stakeholders, particularly investors, who want comparability of information, who do want still to have a check on financial performance, and who want metrics? Well, in terms of comparability, that argument only works if what you are comparing is relevant information and useful to your decision making. And the point that we would make quite often in reports that run to 1,000 pages or more is actually how much of that information is relevant to the business as the board actually runs the business. How much of that information is considered at board meetings, at management meetings, to actually run the business? And what you find often when you talk to boards is quite often it's not. It's seen as a compliance exercise, and they want to be talking about the strategic issues that quite often don't feature in the annual reports. And I know through the strategic report, the FRC is trying to change that within the UK context and is being successful in changing that. But in so many areas around the world, companies are competing for the length of their reports, for the amount of disclosure, and quite often the important information can be hidden in the weeds of data rather than expressed through something that is simpler and more concise to the market. The second point really is around the check on financial performance, and that is fine so long as it fits into the strategy of the organisation and reflects the decisions of the board or management of the company, because that is how you get accountability and strengthened corporate governance. And in respect of those who call for who demand more metrics, and when we talk about the 6 capitals, which I'll talk to you about in a moment, people say, but how can you have a metric, a meaningful comparable metric for human capital or intellectual capital? Well, some things can be measured, and where they can be measured and where they can be compared, that should be included, and we would encourage that. But some things simply cannot be measured and included as a financial or a number metric within an annual report. And we need to give prominence to narrative reporting, and we need to reassert the value of narrative reporting to give context to the numbers, to give context to that quantitative information. So integrated reporting really is a combination of high quality, qualitative and quantitative information, and we should not be afraid where metrics are not available to say that here we have qualitative information running alongside it. And that is certainly a message that we've been sending to the European Commission, because they're developing non-financial reporting a directive which is around more and more disclosure on environmental and on diversity issues as well. And what we're saying is, yes, produce the data, but it has to fit into the strategy and the decision making of the company. It shouldn't just be about the impact of the company on society and the environment. It should be on how does that impact back on the business model of the organisation. And that really does bring us to a diagram from the International Integrated Reporting Framework that we released in December 2013. And at its heart is the idea of the business model. And this diagram is affectionately known as our octopus diagram for obvious reasons. And what it shows is the inputs on the left, the 6 capitals as we call them, which are the resources and relationships that most organisations will draw upon in order to do their business and create value. And they are financial, manufactured, intellectual, human, social and relationship and natural capitals. And what happens to them is that they are transformed by the business as the business produces its goods and services. And in addition to producing those goods and services, the outputs, there are also outcomes that accrue to the business and perhaps to society as well. And what we encourage is for the company to report that process with the business model very much at its heart. And we believe that this will help both to shape the future of corporate reporting and close some important information gaps that currently exist within capital markets. So what integrated reporting does is it introduces a multi-capitals model. into mainstream corporate reporting, which redresses the issue of the primacy of financial reporting alone, but it puts financial reporting in a proper context alongside other drivers of value creation, especially those drivers of value creation that are leading indicators of future value. Secondly, it enables a business to explain the transformation in capital brought about by its activities and its business model. So it provides insight over those resources. Third, it provides insight into management decision-making, and particularly the trade-offs that management might make between different forms of capital. So a business, in order to improve its operational efficiency or its productivity, may decide to invest in training for its workforce. So it's depleting its financial capital, but it intends to increase the value of its human capital in the short and medium term, which will then have a long-term impact, hopefully, on the value of its financial capital. So what the business should be able to do is explain these trade-offs, which happen all the time, but are simply not explained in corporate reporting terms. Fourth, it closes vital information gaps, and we see evidence now coming through from Harvard Business School that shows that by closing down information gaps, businesses can now choose the type of investor they have investing in their business. So businesses no longer have to have traders constantly trading on their share price. They can attract long-term investors by the type of corporate reporting formality that they adopt. And fifth, accountability is enhanced, particularly over different time horizons, because what integrated reporting does, particularly with some of the non-traditional capitals like intellectual capital and human capital, you're orientating the business into the future. So you're telling a story about future value, not just value in the short term. Now, what is absolutely critical is that this is not a theory, that this is actually happening in markets around the world. And we've now got about 1,500 companies in the world that are adopting integrated reporting. Companies like Nestle, Unilever, M&S, SAP, banks like Itaú Unibanco, the largest bank in Latin America, Deutsche Bank, HSBC, DBS Bank in Singapore, and also some stock exchanges, the Singapore Stock Exchange, Deutsche Börse, Tokyo Stock Exchange, and the South African Stock Exchange at Johannesburg. All these companies and many more are adopting integrated reporting as their reporting formality of choice. And apart from in South Africa, where it is mandated into the listing requirements of the Johannesburg Stock Exchange, this is a market-led initiative. So it's businesses choosing to adopt integrated reporting, and quite often, and this is certainly in respect of strategic reporting, we try to work with regulators and drive consistency between what we're doing and what is happening within national jurisdictions. But quite often companies, even in the US, where there's more of a compliance-based mentality, even companies there like Microsoft and PepsiCo and so on are adopting integrated reporting as their chosen reporting formality. And what we find is the evidence really backs up the move from traditional reporting to integrated reporting, and we're not aware of a single company in the world that has started on the journey and then chosen to reverse and go back to traditional reporting. And maybe there's an explanation for that. The South African Institute of Chartered Accountants did some research from non-executive directors and found that integrated thinking, which is the process of decision-making within the business that drives integrated reporting, increases the quality of an organisation's dialogue with its shareholders. Research looking at the IRC's own companies that are doing integrated reporting shows that 80% of investors better understand the strategy of the business. Research conducted by Black Sun, a UK corporate reporting consultancy, showed that 92% of businesses better understood value creation for their company. And a survey from PwC, a survey of institutional investors, showed that 80% of those investors said that the quality of corporate reporting affected their professional perception of management quality. So they're looking at the quality of reporting and using that as a proxy for the quality of the management. Now, we understand that corporate reporting does not sit within a silo, and better reporting in and of itself is good, but it will have a limited impact in terms of capital market decision making and economic decision making. And so we have got a whole program of policy engagement globally with the G20 and with others. And what we're calling for is for integrated reporting as part of a package of reforms to capital markets and economic decision making. So we want to see a shift from a system focused primarily on financial capital, on a financial capital market system, to one that is far more inclusive, that takes into account those broader drivers of value creation. And we've got some important allies in this. In a speech that was given on the 18th of May, Andy Haldane, the chief economist of the Bank of England, made a speech called The Great Divide. And he said that capital has more than one face. And he was speaking particularly in respect of banks and financial services company. But he said trust, what he calls social capital, matters more with banks and needs to be factored in to economic modelling. He said trust plays a crucial role in value creation. A lack of trust in finance potentially hobbles both economic growth and financial stability. So what we're calling for there is a change in the way we think about financial capital, and change that to be more inclusive of social capital, natural, human capitals as well. We need to move from our capital markets, and people like Professor John Kay, who did a great study a few years ago into the reasons why there is so much short-termism in our capital markets. And he made a number of important recommendations, including some on financial and corporate reporting. But we do need to see a shift from short-term capital markets to sustainable capital markets, where you can see over the horizon. When you look at an annual report or when you speak to a company, we need to see over the horizon. And then fitting into that, we do need to move away from information presented by companies in silos, the financial data, the sustainability data, the governance data, and we do need something that is far more integrated and complete and holistic when we read the story from a company or speak to a chief executive or turn on the radio and listen to the results of a company. It cannot just be about the last quarter's financial results. It has to be about the strategy of the company and how the management of that company is meeting its long-term strategic goals. I just wanted to conclude on some work that we've been doing, particularly with the accountancy profession. And the accounting profession is incredibly supportive of integrated reporting. All the main accounting bodies and accounting firms sit in one way or another within the IRC family and supporters. But there is really a crossroads approaching for the profession as we consider the issue of compliance versus what I understand to be really cherished principles of accounting, which are judgment and opinions. And in many ways, that judgment, that professional judgment, has in a way taken second place, particularly in corporate reporting terms, to compliance and box ticking. And what we would argue is that the profession really does have to reassert, when it talks to policymakers, when it talks to business, when it talks to investors and those involved in the capital market, has to reassert those values of judgment and opinion, because it's what sets the accounting profession apart. The judgment, the opinions based on the ethical foundations of accountancy training, and quite a lot of that has got lost. If you speak to people within the corporate reporting world, it's about disclosure requirements, it's about compliance, and it's about box ticking. It isn't about the exercise of judgment and the exercise of opinion based on that training and based on that ethical background. And I think we do need to get back to that. We've done a piece of work looking at the origins of financial reporting, and particularly, as you'll all know this, the double entry bookkeeping with Luca Pacioli in Renaissance Italy, and how what his vision was as a mathematician was to take maths out of the library, as he called it, and to actually put maths to some kind of practical use. And what that spurred was the development of double entry bookkeeping, which enabled the isolation of profit, which led to all the trade and the economic development that we've seen, and the breaking down of barriers, and the growth and the reduction in poverty, and everything that we can attribute in a way to capitalism can, one way or another, be derived back to that moment in time. And it really remains a foundation of accountancy today. But what we often ignore, I think, is the way corporate reporting and financial reporting has evolved over the centuries, from the 15th century, from the 16th century to today. And it's almost stalled in the mid part of the last century, where we still focus just on the financials and historic. Whereas if you think about the evolution of capital markets and regulation from the 16th century, with the creation of the professions in the 19th century, to the capital markets in the 20th century, to the Companies Acts in the late 20th century, and now to the evolution of sustainability reporting and CSR reporting, we really do need to look again at the system of corporate reporting and make sure that it is fit for the 21st century. And I would argue that that should be based on the principles of sound corporate governance and stewardship as well. And then just finally, the demand for this kind of information isn't just coming from corporates and isn't just coming from the accounting profession. It's coming from some pretty senior people within the world of investment as well. The CEO of the largest equity house in the world, BlackRock, Larry Fink, writes an annual letter to the CEOs of S&P 500 companies in the States and European CEOs as well. And he has called for an annual strategic framework for long-term value creation from every company that BlackRock invests in. And the CFA Institute, the financial analysts, have said, well, really, we've got the framework that it would enable that information set to come through, and it's called the International Integrated Reporting Framework. And so companies should start to adopt that in order to meet the needs of people like Larry Fink. And we're also seeing support from regulators around the world. UK Sinha, the chairman of the Securities and Exchange Board of India, has said it's not a question of if integrated reporting is adopted in India, but a question of when. And he has charged the Confederation of Indian Industry to come up with a roadmap for how integrated reporting will be adopted in India in a way that is non-disruptive to the Indian business community. And Stephen Hadrell, the chief executive of the Financial Reporting Council, has said that we're on the same journey and with the same purpose, and that the principles of the strategic report are consistent with integrated reporting. And we've also had support there from Mark Carney as well. What I wanted to just conclude with is to say that this presentation has been called Accounting for Valuation in an Age of Transparency. And there are three things that I would really want to take away from my talk. And one is that I think we do need to think about value creation and value differently. And we need to embrace the concept of capitals in a multi-capital sense in order to understand and then articulate value creation. I think we need to give ourselves permission in this generation, as others have in the past, to innovate. And I would again, at the end of my talk, congratulate the FRC in the UK for innovations like the Financial Reporting Lab and the kind of the very progressive work that they've done to encourage innovation in what is a very complex and compliance-based world. And the third point really comes back to the role of the accountancy profession. You know, let's not allow the compliance mindset and the box-ticking mindset to take over the way we think about business and the way we think about corporate reporting. If we believe in judgment and opinion, then let's assert those principles when we talk outside to business, to investors, and to capital market decision makers, because the accountancy profession could well lead this movement towards a broader-based and inclusive corporate reporting system that should help to restore some of the trust and accountability to corporate governance and to the management of business. Thank you.